Japan's bond market is fracturing, not cracking, fracturing. The difference? One suggests a warning. The other signals the breaking point has already been crossed. Japan's 30-year bond yields just hit levels not seen since these instruments were created in the late 1990s. At the exact moment, the country is sitting on $10 trillion in government debt. $10 trillion. And here is what almost no one is discussing. Japan holds over $1 trillion of American Treasury bonds, making it the largest foreign creditor to the United States. So when Japan's financial structure begins to fracture, the question is not whether it affects the rest of the world. The question is how fast the contagion spreads, and whether anyone is prepared for what comes next. Welcome to your John AG. If you have been observing markets long enough to remember when interest rates actually meant something, when central banks operated with discipline rather than desperation, then you understand why this channel exists. We do not chase trends here. We analyze structural shifts before they become headlines. If that approach resonates with your experience and judgment, consider subscribing, not because algorithms demand it, but because serious analysis deserves a serious audience. And before we proceed, drop a comment below. Tell us where you're watching from, whether you're in Tokyo, New York, London, Singapore, or anywhere else where capital markets matter. Geographic perspective adds context to analysis. Now, let us examine exactly what is fracturing in Japan, and why the consequences extend far beyond Japanese borders. In the quiet halls of Tokyo's financial district, something extraordinary is happening. Bond traders are watching screens with an intensity rarely seen in Japanese markets, because the numbers staring back at them represent more than statistical movement. They represent the unwinding of a 4-decade financial experiment. Japan's 30-year government bond yield has climbed to levels not witnessed since the late 1990s, a technical statement that carries profound implications. For those unfamiliar with bond mechanics, the relationship is inverse and unforgiving. When bond yields rise, bond prices fall. And when a country holds $10 trillion in outstanding government debt, rising yields do not simply adjust portfolio values. They threaten the entire fiscal foundation of the nation. Japan is not a small economy experimenting with unconventional policy. It is the 4th largest economy on the planet, a manufacturing powerhouse, a technological leader, and most critically, the world's largest net creditor nation. For decades, Japan operated as the quiet banker to the world. Japanese institutions lent money globally, financed American debt, funded infrastructure across Asia, all while maintaining a domestic bond market so stable it was considered virtually risk-free. The Japanese government bond, known in financial circles as a JGB, became synonymous with safety. Yields stayed near zero for so long that an entire generation of traders never experienced volatility in this market. But stability built on suppression is not the same as stability built on strength, and the difference is now becoming painfully clear. The Bank of Japan spent years implementing policies that would have been considered impossible in previous eras of central banking. Zero interest rates became negative interest rates. Quantitative easing became yield curve control, each policy designed to stimulate an economy trapped in deflation, to encourage borrowing and spending in a society that preferred saving. These policies worked in the sense that they achieved their mechanical objectives. The central bank controlled yields. The government financed massive deficits at virtually no cost. Markets remained calm. But beneath this engineered calm, structural imbalances grew. Japan's debt-to-GDP ratio climbed above 260%, the highest among all developed nations, nearly double that of the United States. For comparison, when Greece faced its sovereign debt crisis, its debt-to-GDP ratio was approximately 180%. Japan sailed past that threshold years ago without triggering market panic. Why? Because Japan is different in one critical way. It owes money primarily to its own citizens. Japanese government bonds are held overwhelmingly by Japanese banks, insurance companies, pension funds, and households. This created a closed loop that seemed sustainable. The government borrowed from its own people, in its own currency, with a central bank willing to intervene without limit, but closed loops have a weakness. When pressure builds inside a closed system with no release valve, the entire structure becomes vulnerable to fracture, and that fracture is now visible. The rise in bond yields means something fundamental has shifted. Either the Bank of Japan is losing control of its yield curve targeting, or it is choosing to allow yields to rise. Or market forces have become too powerful to suppress. None of these explanations offer comfort. Each suggests that the era of infinite monetary control is ending. For the global financial system, this matters immensely. Japan holds over $1 trillion in United States Treasury securities, making it the single largest foreign holder of American government debt. Japanese insurance companies and pension funds are massive players in global bond and equity markets. The Japanese yen serves as a funding currency for what is known as the carry trade, A strategy where investors borrow in yen at low rates and invest in higher yielding assets elsewhere. Trillions of dollars in global positions are built on the assumption of yen stability and low Japanese rates. When those assumptions change, the positions unwind, and when trillions of dollars in leveraged positions unwind simultaneously, markets do not adjust smoothly, they break. This is why what is happening in Japan cannot be dismissed as a localized issue. The bond market fracture in Tokyo is not an isolated event. It is a stress test for the entire architecture of global finance, built over decades on the assumption that central banks could control everything, that debt levels did not matter as long as central banks kept buying, that risk could be perpetually suppressed through monetary policy. Japan is now testing whether those assumptions were ever true, and the early evidence suggests they were not. The fracture has begun. The question now is how far it spreads. Financial contagion does not announce itself with sirens or warnings. It moves through invisible channels, through derivative contracts and currency swaps, through algorithmic trading systems programmed to react faster than human comprehension. And right now, those channels are beginning to pulse with activity originating from Tokyo. To understand how a fracture in Japan's bond market becomes a global crisis, one must first understand the carry trade. Imagine a strategy so elegantly simple it seems almost risk-free. An investor borrows money in Japanese yen at near zero interest rates, converts those yen into dollars, euros, or any other currency, then invests in higher yielding assets abroad. The difference between the borrowing cost and the investment return becomes profit. For years, this worked flawlessly. Hedge funds borrowed in yen to buy American stocks. Corporations borrowed in yen to finance operations in emerging markets. Real estate investors borrowed in yen to purchase properties across Asia and beyond. The scale of this activity is staggering. Estimates suggest trillions of dollars in positions are built on yen-denominated borrowing. The exact number remains unknown because much of this occurs off-exchange, in private transactions between sophisticated institutions. But the mechanism is identical across all participants. Borrow cheap in yen, invest expensive elsewhere. Pocket the difference. This strategy has one critical vulnerability. It requires two conditions to remain constant. Japanese interest rates must stay low, and the yen must remain weak or stable against other currencies. Break either condition, and the entire structure collapses inward. Right now, both conditions are breaking simultaneously. As Japanese bond yields rise, borrowing costs increase. As the Bank of Japan signals potential policy normalization, the yen strengthens. Suddenly, positions that generated profits are generating losses. And in leverage markets, small losses trigger massive liquidations. Traders who borrowed in yen must now buy yen to repay their loans, which pushes the yen even higher, which forces more liquidations, which accelerates the cycle. This is not theory. This is observable in real-time market movements. The yen has already appreciated sharply against the dollar in recent months, catching many participants off guard, forcing hurried exits from crowded positions. But the carry trade is only one transmission channel. There is another, perhaps more dangerous pathway for contagion. Japan's holdings of United States Treasury securities, over $1 trillion, the largest foreign creditor to the American government. For decades, this arrangement worked symbiotically. Japan earned returns on safe American debt. The United States benefited from reliable foreign demand for its bonds, a stable, predictable relationship. But what happens when Japan needs that capital at home? If Japanese bond yields continue rising, the Japanese government faces a fiscal crisis. Debt servicing costs explode. Budget deficits widen. The government needs funding. Where does that funding come from if domestic sources are exhausted? One option is liquidating foreign assets, selling U.S. treasuries, repatriating capital. Even a modest reduction in Japan's treasury holdings sends ripples through American bond markets. If Japan sells, yields rise. If yields rise, borrowing costs for the U.S. government increase. If borrowing costs increase, fiscal pressure mounts in Washington. And that pressure occurs at a moment when American debt levels are already approaching $5 trillion annually in deficits. The United States cannot afford a major creditor stepping away from the market. Yet Japan may not have a choice. This creates a coordination problem between two of the world's largest economies, both facing debt sustainability questions, both reliant on continued access to bond markets, both vulnerable to sudden shifts in investor confidence. Then there are the Japanese banks. These institutions are not like their Western counterparts. Japanese banks hold enormous portfolios of Japanese government bonds. For years, this seemed prudent. Government bonds are considered safe assets for regulatory capital purposes. They generate predictable income. They satisfy liquidity requirements. But safety is contextual. When bond yields rise sharply, bond prices fall sharply. Banks holding massive bond portfolios face mark-to-market losses. These losses impact capital ratios. If capital ratios fall below regulatory thresholds, banks must raise new capital or shrink their balance sheets. Shrinking balance sheets means reducing lending. Reduced lending means economic contraction. Economic contraction means lower tax revenues and higher government deficits. Higher deficits mean more bond issuance. More bond issuance without sufficient buyers means higher yields. Higher yields mean more losses for banks. The feedback loop becomes self-reinforcing, and Japan's banking system is not designed to withstand this kind of stress. Decades of ultra-low rates have compressed profit margins. Banks survived on volume, not margin. They have limited buffers against sudden shocks. A full-scale banking crisis in Japan would not remain contained within Japanese borders. Japanese banks are globally interconnected through currency markets, derivative exposures, and interbank lending. A liquidity crisis in Tokyo becomes a liquidity crisis in London, New York, and Singapore within hours. This is the architecture of contagion, not a single catastrophic event, but multiple reinforcing mechanisms that amplify initial shocks into systemic breakdowns. The fracture in Japan's bond market is the initial shock. What follows depends on how quickly these mechanisms activate, and whether policymakers can interrupt the feedback loops before they become uncontrollable. The evidence suggests they are already struggling. There is a concept in economics called the impossible trinity. It states that a country cannot simultaneously maintain three things: a fixed exchange rate, free capital movement, and independent monetary policy. A nation must sacrifice one. Japan now faces a different kind of impossible choice. Not a trinity, but a trilemma equally unforgiving. It cannot simultaneously defend the yen, control bond yields, and maintain financial stability. The mathematics simply do not allow it. And watching policymakers attempt to navigate this reality has become a study in constraint management under extreme pressure. The Bank of Japan finds itself in a position no central bank wants to occupy. For years, it implemented yield curve control, a policy framework designed to keep government borrowing costs artificially suppressed. The central bank announced target levels for bond yields, then intervened in markets to enforce those targets, buying unlimited quantities of bonds whenever yields threatened to rise above the ceiling. This worked as long as market participants believed the central bank had infinite capacity and commitment. But belief is fragile, and once it cracks, no amount of intervention can fully restore it. The first cracks appeared when inflation began rising in Japan. After decades of deflation and stagnant prices, Japanese consumers suddenly faced increasing costs. Energy prices climbed, food prices rose. Import costs surged as the yen weakened. For the first time in a generation, inflation became a political issue. The Bank of Japan faced a dilemma. Traditional central banking doctrine says that rising inflation requires raising interest rates. But raising rates in Japan means abandoning yield curve control. And abandoning yield curve control means bond yields rise. And rising bond yields on $10 trillion in government debt means fiscal catastrophe. The government's annual interest expense would multiply. Budget deficits already measured in hundreds of billions would expand further. Funding those deficits would require issuing more bonds. Issuing more bonds into a rising yield environment creates a vicious cycle, so the central bank hesitated. It adjusted yield curve targets incrementally, allowing slightly higher yields while claiming control remained intact. Markets interpreted this hesitation as weakness, and markets attack weakness. Bond vigilantes, those investors who sell bonds to punish perceived fiscal irresponsibility, began testing the Bank of Japan's resolve. They sold Japanese government bonds, pushing yields higher. The central bank intervened, buying those bonds, but each intervention depleted the central bank's credibility and expanded its balance sheet further. There is a limit to how much debt a central bank can absorb before it loses institutional legitimacy. Japan is approaching that limit. Meanwhile, the yen became another battlefield. As bond yields rose and foreign investors grew concerned about Japanese stability, capital began flowing out. The yen weakened dramatically against the dollar. A weak yen benefits Japanese exporters by making their products cheaper abroad, but it devastates consumers by making imports more expensive. And Japan imports virtually all of its energy and significant portions of its food. Currency weakness became inflation. Inflation became political pressure. Political pressure forced the Ministry of Finance to intervene in foreign exchange markets. They sold dollars and bought yen, attempting to support the currency. But currency intervention consumes foreign exchange reserves. Japan's reserves, while substantial, are not infinite, and each intervention signals desperation rather than strength. Here's where the trilemma becomes inescapable. If the Bank of Japan defends yield curve control by buying bonds aggressively, the yen weakens further as markets question sustainability. If it allows yields to rise to defend currency credibility, government financing costs explode and fiscal crisis accelerates. If it tries to maintain both targets simultaneously, it burns through reserves and credibility until neither goal is achievable. There is no fourth option. There is no escape route that avoids pain. Compounding this policy paralysis is Japan's demographic reality. The country is aging faster than any major economy in history. Over 28% of the population is now over 65 years old. The working age population shrinks every year. Fewer workers mean lower tax revenues. More retirees mean higher Social Security and healthcare costs. The fiscal burden increases automatically, regardless of policy choices. Productivity growth could theoretically offset demographic decline. But Japan's productivity growth has been anemic for decades. Structural reforms could boost productivity. But structural reforms require political will that has proven elusive across multiple administrations. Immigration could expand the workforce. But Japan remains culturally resistant to large-scale immigration. Every potential solution confronts either economic constraints or political impossibility. The government is trapped between mathematics and sociology, and mathematics always wins eventually. International pressure adds another layer of complexity. The United States and European nations watch Japan's currency movements with concern. A sharply weaker yen makes Japanese exports more competitive, which damages industries in other countries. Trade tensions rise. Accusations of competitive devaluation surface. G7 finance ministers exchange carefully worded statements expressing concern. But beyond statements, options are limited. Currency swap lines exist between major central banks, emergency lending facilities that can provide temporary liquidity. But these are designed for short-term crises, not structural insolvency. Japan's problem is not a temporary liquidity shortage. It is a fundamental mismatch between debt obligations and the capacity to service them sustainably. No swap line fixes that. No coordinated intervention solves that. Only painful adjustment can resolve it. And painful adjustment means some combination of higher taxes, lower spending, financial repression, or debt restructuring. Each option is politically toxic. Each option threatens social stability. So policymakers delay. They adjust targets incrementally. They communicate in deliberately vague language designed to buy time rather than solve problems. They hope that external conditions change favorably before internal constraints become binding. But hope is not a strategy, and time is running out. The bond market is fracturing not because investors are irrational, but because they are calculating the probability that Japan's impossible trilemma resolves through some form of crisis rather than controlled adjustment. And that probability is rising. Every policy announcement is scrutinized for signs of capitulation. Every data release is analyzed for evidence of deterioration. The margin for error has disappeared completely. Japan's policymakers are navigating without room for mistakes in an environment where mistakes are inevitable. This is the constraint that matters most, not the debt level itself, not the demographic challenge itself, but the absence of any policy path that avoids significant pain. The fracture continues to widen. The fracture in Japan's bond market is not a distant abstraction. It is a force already reshaping the landscape where capital is deployed, where businesses operate, where investment decisions succeed or fail. And those who treat it as someone else, this problem will discover too late that financial contagion recognizes no borders. For portfolio managers and institutional investors, the immediate challenge is reassessment. Every fixed income portfolio constructed over the past decade assumed a certain baseline, that central banks would suppress volatility indefinitely, that duration risk was manageable because yields would remain anchored, that Japanese government bonds represented the ultimate safe haven in Asian markets. Those assumptions are now obsolete. Duration risk, the sensitivity of bond prices to interest rate changes, has returned with force. Portfolios holding long-dated bonds face mark-to-market losses as yields rise. The longer the duration, the more severe the impact. Investment committees that ignored duration risk for years because it seemed irrelevant must now confront it as a primary concern. Rebalancing becomes necessary. But rebalancing during market stress means selling into weakness, crystallizing losses rather than riding out temporary fluctuations. This is not a temporary fluctuation. This is a structural repricing of risk that has been mispriced for over a decade. Currency exposure presents another dimension of complexity. Any investor holding yen-denominated assets faces translation risk as the currency fluctuates. A strengthening yen benefits those holding Japanese assets when converted back to dollars or euros. But a disorderly strengthening, driven by carry trade unwinding rather than economic fundamentals, creates whipsaw volatility. Hedging strategies that worked in stable environments fail when correlations break down. Traditional currency hedges assume normal market functioning, but stress conditions produce abnormal price movements that overwhelm standard hedging approaches. The cost of hedging rises precisely when hedging becomes most necessary. This forces a choice between accepting unhedged currency risk or paying insurance premiums that erode returns. Neither option is appealing. Both reflect the reality that risk cannot be eliminated, only transferred or accepted. Equity portfolios face sector-specific vulnerabilities. Japanese financial stocks, particularly banks and insurance companies, are directly exposed to bond market stress. Their balance sheets hold enormous quantities of Japanese government bonds. Rising yields mean falling asset values. Falling asset values mean pressure on capital ratios. Pressure on capital ratios means potential dividend cuts, capital raises, or forced deleveraging. None of these outcomes support equity valuations. Investors holding Japanese financials must evaluate whether current prices adequately reflect these risks. In most cases, they do not. Markets are slow to price structural deterioration until it becomes undeniable. By then, the opportunity to exit at reasonable prices has passed. Japanese exporters face a different calculus. A weaker yen traditionally benefits export competitiveness, but the current yen weakness is coupled with rising input costs and supply chain fragility. The benefit of currency depreciation is offset by the cost of imported materials and energy. Margins compress rather than expand. Additionally, if yen weakness triggers trade tensions or protectionist responses from trading partners, export volumes may decline regardless of price competitiveness. The simple narrative that weak yen equals strong exporters no longer holds. Context matters more than currency direction alone. For multinational corporations with operations in Japan, operational risks multiply. Supply chains dependent on Japanese components or manufacturing face potential disruption. If Japanese banks reduce lending due to capital constraints, corporate financing becomes more difficult. If economic contraction follows financial stress, domestic demand for goods and services falls. Companies must evaluate their Japan exposure not as a stable input, but as a variable that could shift rapidly. Scenario planning becomes essential. What happens if Japanese production capacity contracts by 10%? What happens if trade finance becomes scarce? What happens if currency volatility makes long-term contracts unhedgeable? These are not hypothetical exercises. They are contingencies that prudent management must address before they materialize. Capital allocation decisions require recalibration for a higher cost of capital environment. For years, businesses operated under the assumption that money was cheap and would remain cheap. Leverage was encouraged, return hurdles were lowered, projects that would not have qualified for funding in a normal rate environment received approval because the alternative was holding cash, earning nothing. That era is ending. As yields rise globally in response to Japan's market stress and broader monetary tightening, the cost of capital increases. Projects that looked viable at 3% financing costs become marginal at 5%. Marginal projects get canceled. Capital expenditure declines. Economic growth slows. Businesses that overlevered during the low-rate period face refinancing risk. Debt that was cheap to service becomes expensive. Interest coverage ratios deteriorate. Credit ratings face downward pressure. This creates a feedback loop where financial stress begets operational stress begets further financial stress. Breaking this loop requires either rapid deleveraging or significant improvement in operating cash flow. In a slowing economy, the latter is difficult to achieve. The former often requires asset sales at distressed prices. Yet within crisis, opportunity exists for those positioned to recognize it. Dislocations create mispricings. Forced sellers create buying opportunities for those with liquidity and patience. Certain sectors and geographies will benefit from the structural changes underway. Companies that provide solutions to the problems Japan faces, automation and robotics addressing labor shortages, healthcare and elder care services for an aging population, energy efficiency technologies reducing import dependence, may find expanding markets and favorable valuations. Investors who can identify these structural beneficiaries before consensus recognizes them will generate asymmetric returns. Similarly, capital repatriation flows from Japan could benefit specific asset classes. If Japanese institutions reduce foreign holdings and bring capital home, which markets face selling pressure and which face buying pressure? Understanding these flows provides positioning advantages. Regulatory and policy developments require constant monitoring. Central bank communications, not just from the Bank of Japan, but from the Federal Reserve, European Central Bank, and others, will signal coordination or fragmentation. Coordinated responses to stress can stabilize markets temporarily. Fragmented responses accelerate contagion. Political developments in Japan matter as much as economic data. Leadership changes, coalition stability, policy priorities all influence whether Japan pursues reform or delay. Markets will price these political dynamics as they unfold. Time horizons must be differentiated clearly. Tactical positioning for the next 6 months requires different strategies than structural positioning for the next 5 years. In the near term, volatility will likely increase. Defensive positioning, higher cash allocations, reduced leverage, increased hedging makes sense for those prioritizing capital preservation. In the medium term, selective opportunities will emerge as markets overreact and create valuation dislocations. Patience and liquidity allow exploitation of these moments. In the long term, the repricing of global risk assets to reflect sustainable debt levels and realistic growth expectations will create a new investment landscape. Those who adapt to this new reality will thrive. Those who cling to the assumptions of the past decade will struggle. The fracture in Japan's bond market is a symptom of a broader unsustainability. Decades of debt accumulation, monetary policies that suppressed rather than resolved imbalances, demographic shifts that undermine fiscal capacity. These forces exist not only in Japan but across developed economies. Japan is simply the leading indicator. The stress test happening now in Tokyo will eventually reach other capitals. The question is not if, but when and how severe. Business leaders and investors who recognize this pattern have time to prepare. Not unlimited time, but enough to reposition portfolios, adjust leverage, diversify exposures, and build resilience. Complacency carries asymmetric risk. The downside of ignoring structural fragility far exceeds the cost of prudent preparation. This is not a prediction of immediate collapse. It is a recognition that systems operating beyond sustainable limits eventually reset. Resets can be managed or chaotic. The difference depends on whether participants act while options remain available or wait until options are exhausted. Japan's bond market is fracturing. The $10 trillion problem can no longer be ignored. And what happens next will be determined not by hope or denial, but by the mathematical realities of debt, demographics, and the limits of monetary intervention. The only question that matters now is whether those exposed to the consequences are prepared for them.